Hello, and thank you for joining us. With me today is David Naughtin. He's a Senior Portfolio Manager for the Fiera Atlas Global Company Strategy, bringing us over 18 years of industry experience. I always find it insightful to take a peek into how you practically manage a portfolio. So could you take us through the process of how a company actually makes it into the portfolio?
So the first stage is idea generation, and ideas for us are generated from screens and industry reviews. But as you know, screens are inherently backward-looking. They can't deal with forward-looking change. So that brings us to stage 2, or the due diligence phase. And this is where we take a deep dive into those companies and the detailed collaboration really kicks in. So we focus our research efforts and budget, greater than 60%, on industry experts such as ex-employees, suppliers, competitors and customers, as we believe they are the best source of forward-looking insight and have the deepest understanding into those long-term drivers of wealth creation. So we typically do 5 to 15 of these calls prior to a name making it into the portfolio, in addition to speaking to the company and sell-side analysts. Now these calls are podcasted for everyone to listen to, so each senior member of the team will qualitatively score each company's wealth creation pillar scores at every stage and will collaboratively discuss the rationale for those rankings. This is really helpful because it directs our due diligence into areas where we have concerns or differing views amongst the team. And it also ensures that each decision is debated and biases are challenged throughout the entire DD process. So if a company makes it through that collaborative due diligence phase, we'll then model it. Modelling or forecasting for us is simply our best quantitative representation of that qualitative fundamental due diligence and helps us make better and more informed decisions. So we'll model 3 scenarios, the base, the bull and the bear case, to assess both the return potential and the range of uncertainty or risk.
Interesting, so a really deep dive into the business analysis. So how does the team think about risk and portfolio construction?
So portfolio construction is stage 3 of the investment process, and risk is a key input into position sizing. So we're looking to allocate capital to risks we understand and avoid those where we have no edge. And we're considering 3 main types of risk. So firstly, it's company or fundamental risk, and this is the primary determinant of long-term investment risk. So well-managed companies led by excellent capital allocators that are highly profitable with strong balance sheets, backed by competitive advantages and structural growth tailwinds, that's your first line of defence. Now we measure this qualitatively via our wealth creation pillar scores, so this is a measure of team conviction. We measure it quantitatively via our model outputs. So specifically, we look at shortfall risk, which is the delta between our base and our bear case expectations. So the wider that spread, the riskier the company, all else equal. Further, each company has its own custom hurdle rate, which is the rate of return we require. So these factors give us great insight into the fundamental downside risk. Now, secondly, it's valuation or multiple risk. So whilst the compounding of cash flows can explain over 80% of long-term returns, if you pay too much for it, you'll dilute the benefit. So we avoid this risk by assuming a conservative through-cycle exit multiple rather than marking to market. So we're trying to make sure that fundamentals do the heavy lifting. And thirdly, it's portfolio risk. So we ensure that the portfolio is not overly concentrated, and we focus on our custom exposures, which are there to determine where we actually earn our cash flows from in terms of end markets and to ensure that they're diversified. So in short, we're building the portfolio bottom up with exceptional companies, position sizing based on risk-adjusted return expectations, which are calibrated via qualitative conviction, shortfall risk and hurdle rates, whilst ensuring adequate diversification of end market demand.
Great. Thank you so much for joining us.
My pleasure. Thanks for having me.